So apologies everyone for the technical glitch. If you can believe it, I can see Comcast headquarters from my office right now, and that's who we use for internet service, literally a block away. And sometimes these problems happen. So welcome everybody. We're on a mission today, in addition of finding an alternative to Comcast. Tony and I want to make you one of the 5% of options traders who actually make money, because the numbers are really that bad. So we're going to show you how to do that. And first, a little disclaimer: we're not registered as a broker-dealer or with any state or federal regulatory agencies. Everything we're talking about today is for educational purposes only. My background is fairly simple: 50 years on Wall Street, 45 years using technical analysis. I headed the options department at a regional firm called Tucker Anthony and R.L. Day with 250 stockbrokers and tens of thousands of options traders. And that's how I know that only 5% of options traders make money, because I lived and breathed that for 5 years in spite of my best intentions showing them how to use technical analysis to create better options trades. Along the way, I've been mentored by some of the smartest and most successful institutional investors, trying to show them how to use technical analysis in their investment decision making, very much like we're going to do on today's webinar. And the reason that's important is everything I learned from these mentors, either colleagues or clients, is reflected in the Chaikin Power Gauge rating, which is our fundamental indicator that we launched 6 years ago that gives you the directional edge you need to trade options successfully. It's the culmination of my life's work. In a minute, I'm going to introduce our friend and partner, Tony Zhang, who's going to talk about his life's work and how that has culminated in OptionsPlay. In fact, this is a good time to bring you on, Tony. Hopefully your internet connection did not go down.
Yeah, I'm here, Mark. Thank you. Thanks everyone for joining us this afternoon. My name is Tony Zhang. I run the product strategy team here at OptionsPlay. And today we're going to show you how the combination of Chaikin Analytics and OptionsPlay is a really powerful combination. We started this company about 4 years ago with the intentions of really revolutionizing options trading. And that's what we're going to show you today. We looked at the user experience that someone uses to trade options. We looked at the chains. We looked at how many different screens options traders needed to kind of keep track of all the things they needed to look at to place an options trade. And we condensed it and built a new experience to how to quickly find option strategies, how to analyze them very quickly, and have the guidance to leverage options for any given outlook, whether you're bullish on a stock, bearish on a stock, or just looking for income. We'll be able to show you today how, using the combination of the Chaikin Power Gauge to gain a directional view with the OptionsPlay tool, how you can quickly leverage any directional view into a very powerful options play. So that's what we're here to show you today. My background actually comes from the FX trading. I was a currency trader for about 7 years at a firm called Gain Capital. Some of you that trade Forex, you might know it as Forex.com. And that's where I've developed, I guess you could say, expertise on the market. I started actually in FX options and then started trading futures and equities myself in my own trading account. And then I started to realize that there was a lot of fragmentation that traders experience, because I had 4 screens on my desk just to keep track of all the different things I needed to place an options trade. So that's what we really built today, is a tool that allows you to condense all of that information into one screen. So all the relevant information you have is given to you immediately without you having to search for anything. And then we provide analytics on top of that to provide guidance so that you can make smart decisions when it comes to your options trading. So with that, I'll hand that back to Mark, and I'll be coming back a little later to show you our tool.
Thank you, Tony. And let me tell you what you're going to learn in the next 45 minutes. And I'd like to ask you to allocate an additional 15 minutes. We have so much to cover that I think it'll be well worth your time. And we have a special offer for you at the end of the webinar. So in the next hour, you'll discover the 4 keys to profitable options and swing trading. Basically, you need a directional edge. That's our Chaikin Power Gauge fundamental stock rating. To make money in options, got to know where the stock is going. I don't care what the probability tables tell you. If you have a directional edge, you're going to make money consistently over time. Very important when you're picking stocks to know which stocks are outperforming and underperforming the market. And also to know what the institutions are doing, because the institutions drive the market. They use fundamentals. That's why our power gauge rating is so important. And then finally, for options traders, exit and entry signals, very important. Now, I'd like you to ask yourself a question as we dive into the webinar. Do you know where to look for profits in 2017? Do you have a plan? Is there a random sort of aspect to your options trading where you're looking here and there or trading the same stock from both sides of the market? None of this plays out well, but having a plan does. So we're going to focus on what that plan could be using Chaikin and OptionsPlay. I think it's also important to know the trend of interest rates, and I'm going to explain that in a moment. Also, the trend of corporate earnings. We're entering earnings season on Thursday when the major banks start reporting, and there are wonderful opportunities to make money in options during earnings season, but it also helps to guide what the ultimate market direction view is. And you don't have to be a market technician full-time to know which direction the market is headed and try and trade with the trend and not against. And then finally, stock selection. Very important. Obviously, if you find the right stocks, the options trades, particularly with OptionsPlay, are relatively easy. And I don't think anybody has ever used the words easy in options before, and I feel comfortable doing that. So what is the likely scenario for 2017? Well, it's in the upper right quadrant here: higher interest rates and rising earnings. Now, the Fed has told you that they're going to raise rates another 2 times in 2017. It's not a guarantee, but they've also said in the Fed minutes that were released last Wednesday that they're going to be lightening up their balance sheet. They bought $4.3 trillion of fixed income investments over the last 7 years to try and stabilize the economy after the financial collapse of '08. They want to unwind that balance sheet. That means they're selling bonds or letting the bonds that they own expire when they mature without replacing them. That's tightening. It all leads to higher interest rates. When you combine higher interest rates with rising earnings, and that's the expectation here in the first quarter, that we'll repeat what we did in the third quarter of 16 and the fourth quarter, that when we start reporting first quarter earnings on Thursday, we're going to be seeing a 10% year-over-year earnings increase. Now, if you look at CNBC, you're going to hear that, well, they were expecting 15%. Now they're only expecting 10% year-over-year in the first quarter increase in earnings. That happens every quarter. Analysts start out very bullish. They reduce that bullishness. But the combination of higher interest rates and rising earnings normally means a bullish scenario for the stock market. So let's look at 2 charts, 2 exchange-traded funds. One is the TLT. This is the 20-year Treasury bond, sort of the long-term interest rate picture. And in spite of the fact that you're hearing again on CNBC and reading in the press that interest rates are dropping again, this chart tells a different story. As you can see, we've been in a trading range since December. Yes, interest rates dropped dramatically, rose dramatically. Bond prices dropped starting in July and then accelerating after the election. But with the Fed telling you that they're going to raise rates twice again in 2017 and tighten by reducing the bonds on their balance sheet, I think we can expect that interest rates are going up in 2017, not down. That means bond prices are going to drop. Now, when you look at the SPDR, the SPY, which is the most actively traded instrument in the US markets, you get a pretty good picture of what the stock market has been doing and what's likely to happen here. We've been in a very well-defined up channel that began roughly in October of 2016. We broke through the top of that up channel. And one of the things we look at is Chaikin Money Flow. Now, many of you know Chaikin Money Flow from your online brokerage platforms. It's on every one of them, Thinkorswim, Fidelity, Schwab. All of them have Chaikin Money Flow. It measures institutional buying and selling. And institutions and individuals as well use the SPY to put money to work quickly in the equity markets. Individuals tend to trade it. Institutions will often buy the spider and hold on to it and continue to buy it on dips if they're bullish and they want more exposure to the stock market on the long side. So we broke above that upper channel. We came back below it. And now what have we been doing for the last 2 months? We've been in this very tight wedge, as it's known, and one way or another, we're going to break out of that wedge. Right now, the 50-day average, which is at around 23.35 on the SP 500, has been holding the market, and the bottom of that rising wedge is support. We're going to go either one of two ways. That's sort of self-evident, but we're either going to break up above that channel when first quarter earnings come out, and if the expectations are right and it's a blowout quarter, then I think we're going to blow out to the upside, particularly because so many people on CNBC have been bearish in the last week. Even today, almost every analyst, except for the last people on here at the closing bell, are talking about how the market's topping out. We had a big intraday reversal last Wednesday, and that caused a lot of, to the downside, a lot of people to say, that's it, the bull market's over. Well, these things don't happen that quickly. So let's assume we get a pullback. Let's assume we actually break that channel to the downside and break that 2320, 2330 support area. It's not fatal. It's actually an opportunity. Looking back over 72 years to 1945, there have been 75 declines of 5 to 10%. We call that a pullback. But what's interesting is that they last a month, and then within another month, they recover to new highs. The market is resilient when it's in a well-defined uptrend, and we've been in a well-defined uptrend since February of 2016, continuing the bull market that began in March of 09. Now, 75% is about one a year. They average about 6%. So we're already down about 2% from the high. Pretty amazing that with all the geopolitical things that are going on, bombing Syria, fighting with the Russians, Chinese coming over, and then all the gridlock in Washington, which hasn't really changed since the Republicans gained control of both the presidency and Congress. But the market is not going up based on, in my view, the Trump trade, as they say. It's going up because earnings are growing both here in the US and more importantly, worldwide. So a lot of the big multinational companies that export overseas are benefiting from a dollar that's been soft here for the last 6 weeks. Bottom line is, there have only been 11 bear markets, if you look down at the bottom two slices, in 72 years. That's one every 6.5 years. So if you're constantly looking for a bear market around every corner and finding that one indicator that they love to find on CNBC that tells some market guru who's trying to make a name for himself that the market has topped out and is entering into a bear phase, you're missing out on huge opportunities. This webinar is about how to take advantage of opportunities, how to buy when people are fearful and sell when they're greedy, to emulate Warren Buffett. So here's another way to look at it. From the bottom in 2016, February, we've rallied 25% to the March 1st peak. That's caused a lot of analysts to say the market's overvalued, we've rallied 25%, end of the bull market. 75% of the time when they say that, they're wrong. 72 times we've rallied 25% since 1945. Half of those times you go an additional 25%. A quarter of those times you rally, but it's only about a 5% gain. Only 1 out of 4 times do stock prices fall after rallying 25%, and often they rally a bit first. So the odds are in favor of the market continuing higher. The question is when. Now, one more piece of information which I find very interesting. When a bull market ends, in the final year of that bull market, you get a blow off to the upside. That's when people can't get enough of stocks. And what's interesting is, assuming that 2017 may be the end of the bull market, we should have a rally of anywhere from 10 to 20% or more. That coincides with this 25% gain 50% of the time. So we're looking for a modest 2450 to 2500 on the upside, which from the current 2350 level gives you really nice opportunity using options or swing trading to take advantage of what may be a surprise move to the upside. Now, if we haven't convinced you that the market's going up, here's how you hedge a decline. And Tony, you may want to comment on this because this is the OptionsPlay screen integrated into Chaikin Analytics.
Yeah, Mark. So this is the OptionsPlay widget that you'll be able to see, which we'll show you in a few minutes. And as you can see, what we've selected here is the S&P 500, and we've clicked on the I'm bearish outlook. So this is designed to help you very quickly leverage any outlook on any underlying stock, which in this particular case is if you think that April is going to be a down month in the S&P 500 and perhaps you want to put on a hedge, this is a way that you can very quickly see three possible strategies on how to do so. The one on the right here, which is the put vertical, is one very interesting way to potentially hedge a downside move in the overall markets for April and partially into May. And we'll show you some additional examples in a little bit of how you can use a put vertical if you want to be a bit more aggressive, or some perhaps even a more conservative strategy on how to take advantage of this as well. And I'll show that to you guys in a minute.
Well, here's the bottom line on this. Let's say you've got a portfolio with $25,000 in stocks. You can hedge that portfolio for a 4% decline in the market through the end of May by putting on this vertical put spread. How many people on the webinar this afternoon trade put spreads, either long or short, bullish call spreads or bearish put spreads? If you do, type a big S into the question box, please, so that we can gear some of this webinar to the level of interest and activity of the people on it. And I see a lot of you do use spreads. Some say just learning, would like to know more. We'll give you a little education on that as we move through the webinar. But here's a classic example of using options in one of two ways. You can hedge a portfolio. Let's say you have 100,000 in stocks. You believe in our bullish scenario, but you think, well, maybe April after the earnings come out and tax season, the market sells off. Here's a way for less than $1,000 to protect a $100,000 portfolio. You put on 4 put spreads. Total cost $970, and you've protected yourself for a 4% decline in the market down to 2240 on the S&P, currently 2350. Or if you're a speculator, look at that 332% return if the market drops 4%. That's 80 to 1 leverage. Really nice profit to be had by buying the 234.50 put, which is slightly in the money, or was when we took the screen, and selling the 224 put against it. You reduce your cost and your percentage return potential is huge. And that's what we're going to be talking about on this webinar, how to use options sensibly without having to devote an inordinate amount of time. Because information overload is our biggest problem, and that's why the combination of what we do on the fundamental side with our power gauge rating and a couple of technical indicators, and what OptionsPlay does to find you the highest probability options trades or tell you that there isn't a good trade in that particular stock or index, is really the answer to the information overload problem. Because the key to making money is focus, having a plan. It's really hard to focus in what we call the age of distraction with Snapchat and Facebook and Twitter and email and so forth. Very, very difficult to focus. All these gurus on CNBC and Fox Business distracting us with headline grabbing predictions. There's got to be a solution to the information overload problem. And for us, that solution is Chaikin Analytics for iPad and desktop, which incorporates OptionsPlay, which we license because best of breed app that I didn't want to try and recreate. I don't think I could have, even though I've known options for 40 years. What OptionsPlay has done is make it easy. Tony Zhang is going to jump in a few minutes after we've showed you a little bit about Chaikin Analytics and run you through the OptionsPlay module to show you how easy it is to find high probability winning options trades. Now, I mentioned that 95% of options traders lose money, and the reason is they don't understand the need for a directional edge. Again, if you know with some degree of reliability which way a stock is going, and you have a decent sense of timing, you're going to make money in options. We give you that directional edge by combining fundamentals with technicals into a quantitative model that we call the Chaikin Power Gauge rating, and then giving you 6 pairs of buy and sell signals to better time your entries and exits. Now, we talked in the beginning about having a plan. This pyramid encapsulates the Chaikin methodology, and this is a very disciplined plan for dealing with both volatile markets and non-volatile markets. And the markets have gotten a little more volatile here. The VIX picked up, which is the way professionals measure volatility, and it's trading at 15. It was down to 11. What does that mean? It means people are a little bit nervous. Does it mean the market can't go up? Absolutely not. For VIX to really give you an indication that there's a hurricane coming in the market, it's got to go above 25. That's not happening anytime soon, in my view. So this pyramid incorporates a plan that you can use. And at the top of the pyramid is the Chaikin Power Gauge rating. It's our fundamental indicator. You could use other fundamental indicators from Investors Business Daily or Value Line. But every good plan, whether you're a swing trader, an options trader, or investing for your 401k plan, needs to start with some view of the fundamentals. If you're only using technicals, and I've been a technician for 45 years, so I love technical analysis, created my own indicators, as I said. If you're only looking at technicals, you're only getting a small piece of the picture. That's why at the bottom of the pyramid, we do incorporate 2 proprietary technical indicators. Chaikin Money Flow, which, as I said, is on all online brokerage platforms, but also on stockcharts.com, Reuters and Bloomberg if you're a professional. And then Chaikin Relative Strength, very critical to know how a stock is doing relative to the market. And then in the middle of this pyramid, our plan gets implemented with Chaikin buy and sell signals. Now, the power gauge rating is a very simple display. Looks like the gas gauge on your car. But what I like to say on these webinars is that the power gauge is like a Chevrolet with a Ferrari engine under the hood. Looks very simple, but some powerful muscle and number crunching going on underneath. And it can also be your GPS during earnings season. We're going to talk about how you can make money with options during earnings season. Great opportunity. A lot of people shy away. We're going to give you confidence that you can do it using the discipline methodology we're going to talk about. Now, John Carter of Simpler Trading has become a partner of Chaikin. John is one of the best pure traders that I've ever met. He's got a chat room. He's got his own technical indicators on TradeStation and other platforms. And he saw the power gauge rating and called it an objective awesome meter for stocks. Said there are a lot of hyped up tools, but when I find something interesting, I'll let you know. And so he exposed this to all of the Simpler Trading and Simpler Options community because he saw a single tool that combined 20 fundamental and technical factors to anticipate a stock's profit potential. So what were those 20 factors that got John Carter so excited to give us that wonderful testimonial? Well, here are the 20 factors, very transparent. It's not a black box. I distilled these down from 200 in a one-year research project. The model was locked down in September of 2010. It's never changed. Factors are the same. The weights haven't changed. And the reason is this is what's known as an eclectic model. Most people in Wall Street are religious. They cling to their ideas like an anchor in a storm. So you've got value investors like Warren Buffett. You've got earnings momentum investors like Jim Cramer. You've got people who are pure technicians, and you've got people who look at more granular stuff like short interest and insider activity. But the bottom line is, to make money in Wall Street, you can't put your feet in cement, in my view. You've got to look at the world from a lot of different viewpoints. So this model that I created to help level the playing field for investors, give you the same tools that I created for institutional investors for over 40 years, is eclectic. Financial metrics are the bedrock of the model, 35%. This is what Warren Buffett looks at. They don't change very often. Earnings are critical, particularly earnings surprise and earnings consistency. And if you're looking for income opportunities by covered call writing or writing against a position that you already own, earnings consistency is very important. Earnings surprise is particularly important during earnings season, which begins on Thursday, as I've said, because when a company reports better than expected earnings, and I learned this from one of my mentors, George Douglas at Drexel Burnham in the mid-'80s, who did the original research on earnings surprise. So earnings surprise happens when a company disappoints Wall Street analysts by reporting lower than expected earnings or surprises to the upside. Very critical because it causes Wall Street analysts to raise or lower their earnings estimates for the next quarter, for the next year, for the foreseeable future. And it's been demonstrated in academic papers that analyst earnings estimate revisions are the single biggest short-term driver of stock price movements. So we've combined the longer-term bedrock financial metrics with the shorter-term indicators, and then added in 15% for technicals, Chaikin money flow and relative strength. And the end result is an eclectic model that finds a lot of different ways to like or dislike a stock. So a little bit of the performance. In 2016, which was a bullish year, using the Russell 3000 as our universe, the average very bullish stock, 428 of them at any given point in time, were up 32%. How many of you would have liked to have earned 32% on your portfolio in 2016? The average very bearish stock, because this was a bull market year, was up 9.5%. But that's a big wide spread between 32% if you're focusing your long trades just on very bullish stocks, and 9% if you're focusing on bearish stocks, where you don't want to be unless you're trading puts. Now in 2015, totally different picture. The average very bearish stock in the Chaikin power gauge rating was down 17%. These were your energy stocks, small caps in general, rails, whole slew of cloud computing stocks. There was a bear market in energy, as we'll see in a little bit, in 2015, and the power gauge rating nailed it. The average very bullish stock down only 1%. Again, it's that spread between very bearish and very bullish that you need to capture to make money as an investor or an options trader. Now, we've identified a pattern that incorporates that pyramid called the classic Chaikin bull. Power gauge rating is bullish, meaning that the fundamental potential for the stock to outperform the market is strong. Relative performance to the market is strong, telling you that the market agrees with the model. And Chaikin money flow is positive, indicating that institutions are accumulating the stock. And here's an example of a classic Chaikin bull: Applied Materials. It's in the semiconductor industry. The industry group is strong. We're not going to get into industry groups on today's webinar. We do that on other webinars. The trend is strong. The stock's been in an uptrend for 15 months. At the bottom of this 1-year chart taken from Chaikin Analytics is the power gauge ribbon. Red to yellow to green, you can see there's no red here. AMAT has had a bullish or a slightly neutral power gauge rating for 15 months. Right above that, we've converted relative strength from a number into a picture, into a heat map, and colored it red or green. So easy for you to be able to see if a stock is outperforming the market. You could go to Investors Business Daily, who does a great job with a lot of the same data, but it's all tables of numbers. Relative strength is a number from 1 to 99. That confuses the heck out of me. Contributes to information overload. Look how much easier it is when you convert it to a heat map. So in the case of AMAT, the market agrees with the model. That's so critical because no matter how good your fundamental research is, the model, the conventional research, if the market doesn't agree with you, the market always wins. My old friend Marty Zweig said that. Listen to the market because the market always wins. And then above that, we've got Chaikin money flow. We've got our own proprietary overbought, oversold indicator, but we use that as a timing guide. And then here are these oversold buy signals, one of our 6 pairs of signals. You can go to our website, chaikinanalytics.com. We explain each of the 6 pairs of buy and sell signals, how they're constructed, what the rationale is. But very simply, we get an oversold buy signal if the power gauge is bullish. So we've got the fundamental wind at our back. And the stock makes a new 8-day low as it gets oversold. I learned this technique from Larry Williams, who's been a long-distance mentor to me. Very simple entry technique, works about 2 out of 3 times, great for options trading because the time duration is about 5 to 10 trading days. And then the other critical element is earnings. We take the last 4 quarters, show you when they reported, color code that from red to gray to green, depending on whether there was a bullish earnings surprise or a bearish earnings surprise. And we'll see how important that is over and above what you're seeing here, that every time they report a positive earnings surprise, the stock just keeps going higher. That's not always the case, but in this case, it has been. Now, the question always comes up, well, how do I find these stocks? Well, we have lists in Chaikin that find them for you, or we give you a screener where you can screen on any of the factors in the model. Here, I screened for classic Chaikin bulls. Started with the Russell 3000, required that the power gauge rating be very bullish. Look for strong money flow and relative strength. So there's our classic Chaikin bull, only large and mid-cap stocks because small caps are underperforming. And then I added just one other factor, which is I wanted that earnings surprise factor to be strong since we're heading into earnings season. In 5 minutes, I was able to reduce the 3,000 stock universe down to 20 stocks. And I've circled ESNT because we're going to use that as an illustration in just a moment. But 20 stocks, Principal Financial, another stock we're going to look at, number of these, Progressive Corp reporting earnings on Thursday. It's a very tight list of stocks that you can move over into our workspace and monitor for buy signals because these are excellent call buying candidates. And then finally, our classic Chaikin bears. Power gauge rating is bearish, meaning the fundamental potential is negative. Stocks underperforming the market. Chaikin money flow is red, not green, telling you that the institutions are selling the stock. And here's our classic Chaikin bear. Under Armour, prior to this, it was Chipotle, where the power gauge turned bearish at 690 on the way down to 380. Before that, it was Kinder Morgan. Before that, it was Wynn Resorts. Now we've gone back 5 years, and we tend to use these examples for a year because there's a persistency. This doesn't just change overnight. So Under Armour, big darling of the institutional community. You can see the power gauge never bought into it. It's been bearish almost all year. It's been underperforming the market. Can you see the institutional selling and the Chaikin money flow, which stays red even when the stock rallies 10%? And then a beautiful sell signal right ahead of earnings here. In January, another sell signal. The next earnings report up here, April 27th. So we've combined all the information you need on one chart, solving the information overload problem. And I think this is a good opportunity with my mouse on top of the options play button for Tony to share his screen and give you a run through of options play and how powerful it can be in finding profitable, high probability options trades.
Thanks, Mark. Let me just share my screen here. You guys should be able to see my screen now.
Looking good.
Great. So just to recap what Mark was saying is to launch the OptionsPlay widget, you just have to press the options button here at the top of your screen. And once you do that, that will populate a widget that looks like this. And like I was saying before, this is designed to help you very quickly find trading strategies, whether you're trading the underlying stock or trading the option, both. It will provide ideas for you for any given outlook. So for any stock that you type in, you have three selections. You can either say I'm bullish, I'm bearish, or you're looking for income. So right now we're looking at a bearish idea on the S&P 500. I just want to bring this up because this was one of the earlier examples we gave. So if you were looking to either hedge a downside move on the S&P 500, or you have or you just want to take a speculative trade as to a move lower in equities, this is a tool that you can very quickly, once you click on the bearish button, you get three ideas as to how to actually go about doing so. And these three strategies represent three of the most popular strategies, at the same time also representing how someone goes from a stock trader to a simple options trade to a more complex spread trade, which seems like a lot of you do trade these spread trades. And this is designed so that you get a starting point very quickly for any given stock. So here what we have is you can short the stock if you only trade stocks. Shorting the stock is one of the only options that you have. If you're trading a simple option strategy, you can buy a put. So what we have here is a 45-day at-the-money put, which is a good starting point for anyone who's looking for a simple bearish strategy using options. And then lastly, what we have is a put vertical. And the put vertical is always going to take the at-the-money put and then also at the same time select a put to sell against that to bring down the cost of that trade. So as you can see, buying an at-the-money put here cost almost $400. But if you bought this 235, 225 put vertical, it would only cost you $232. So this is substantial savings versus just buying an at-the-money put. And what this does is that if the stock, if S&P 500 moves over, even by small amounts, let's say we think it's going to move down to 230, as you can see here, if you had shorted the stock, you'd make about a 2% return. If you had bought this put, you make a nice 26% return. But if you had bought this put vertical, you'd be looking at 115% return. So this is really why this put vertical here has a higher options play score. And just to explain that a little further, most trading platforms will give you a breakdown that looks something like this. And these are all important numbers such as the cost, max reward, max risk, probability of profit, break-even numbers, and days to expiration. However, the problem with this is that it's not easy to compare. So for example, to short the stock, you're gonna have to put up a lot of margin to do so. And buying a put gives you effectively unlimited reward, because if the stock goes all the way down to zero, you'll make $23,000. However, that's really not realistic for S&P 500 to drop to zero in the next 45 days. So
Tony, could I interject for a second? Something changed with the numbers. The return should be 300% on the put vertical and 100 and something.
Yeah. I was assuming that this stock only moved down to 230.
Okay. If you said that, I didn't hear it. Thank you for clarifying.
No, it's okay. So, if the stock moved down to 230, this is what you'd see. But what I was saying before is that these numbers are difficult to compare because you're trying to assume what happens if the stock goes to zero, or what happens if the stock goes all the way up to infinity. And that's just really not a realistic way to compare these numbers. So what we did is we created an options play score so that we can put multiple strategies on a level playing field that truly allows you to compare them side by side and have a picture of what the true risk reward of each one of these strategies is. And that's what the options play score does. So here I was just saying that if the S&P 500 moved down to that 230 level, you get about 15% return on this put spread. But like Mark was saying, is that if this stock moves down to even to 225, which is not an aggressive move, it's only about a 4% move, you're looking at a 331% return by trading this put vertical here. So this is why this tool is very powerful in helping you very quickly find ideas and how to leverage whether you're bullish or bearish on any underlying stock, as well as create some of the other ones. So an interesting trade that I was looking at on the S&P 500, if you weren't as aggressive, meaning if you're not so sure that the S&P 500 is going to drop, but you think maybe it's topped out and maybe it's not going to go any higher, you can use our strategy constructor to maybe look at some credit spreads, because a lot of people like to trade these credit spreads. So one of the ones that I was looking at was maybe selling the 235s and buying back to 238s has a really good risk to reward as well. So as long as the stock stays below 236.70, which is about $2 higher from where it is today, or about $1.50 higher than where it is today, you're going to make $170 per contract, and your max risk is only $130. So this is another way, a little bit less aggressive than buying a put vertical, but you can also sell a call vertical using this platform to very quickly leverage a bearish idea on the S&P 500. So this is designed to allow you to very quickly, whether you're bullish or bearish. So for example, conversely, if let's say for any reason you're bullish on the S&P 500, you think this thing's really going to take off, then you can click on I'm bullish, and now we're presenting you 3 bullish strategies on how to do so. And you'll get buying the stock, buying a simple call option, and buying a call vertical, which is also designed. These are the 3 most popular strategies that you can take if you're bullish on an underlying stock. Mark, did you want to go through some other examples, or did you want me to kind of go through a few more?
Why don't you go through that Schlumberger example and then walk through some of the other panels briefly, and then I'll pick it back up again, Tony. Thanks.
Sure. One of the examples that Mark and I were talking about earlier today was Schlumberger, which is a energy stock. Many of you have been looking at energy. I think energy is an interesting sector to be looking at, because I think it can really go either way as to whether oil is going to recover or not. So here's an idea that you can take advantage of. This was a symbol that actually generated a sell signal. As you can see on the power gauge rating, it currently has a very bearish rating. So we're looking at some bearish strategies on this, as well as it's generated a sell signal today. So if we do that, if we bring it up, what we're going to be able to see is how do we take advantage of SLV moving lower. So here again, just like the S&P 500, we get 3 strategies: shorting the stock, buying a put vertical, and just eyeballing this chart here where it's trading around 79.5. I think this could easily go down to about 75, somewhere in that level if you're bearish on this particular stock. So this P&L simulator here at the bottom allows you to type in any of these price targets. And Schlumberger also reports earnings on April 21st. So one of the things is that you can use this for is earnings plays. So let's say we're expecting that this stock's going to move down to 75 the day after earnings, which would be Monday, the 24th. So as you can see, if I expect Schlumberger to move down to 75 the day after earnings, now this picture looks a little different. It's telling me that I can take a look at buying this put, because this put gives me the highest return, about a 96% return versus only about a 90% return on the put vertical. However, if let's say I held this all the way to expiration, that's when you can see that the put vertical actually outperforms buying the put. So these are the 2 scenarios that you can put together very quickly using our tool, whether you want to play this as an earnings play. If you do, then I would suggest that you look at buying this put If you think this is going to take a little longer to move lower, then I would suggest taking a look at that put vertical. And this tool allows you to very quickly decipher which one gives you the best return, regardless of any given outlook you may have on this given stock.
That's great, Tony, and I know you're going to pick it up later, but let me move back to our presentation, and we're going to have to go to my desktop to find the presentation, since sometimes disappears when we go off into outer space like that. So here we go. And we're back to our bearish classic bear. Now, two other concepts that I want to have you take away from this webinar. We've been talking about combining fundamentals with technicals, which is the power gauge rating and relative strength, and we call that the dynamic duo. It helps find big winners and losers, and as we'll see in a minute, big winners and losers are an options trader's dream because it enables you to be on the right side of a big move and also go in and out multiple times. The other concept is what we call spotting personality changes, and a personality change is defined very simply. It's a stock that's been outperforming the market, so relative strength is green, begins to underperform. That's really the kiss of death, and then it works also on the upside, as we'll see. So here's a couple of examples of that. Remember when we did the screener for classic Chaikin bulls, we saw ESNT. This had a bullish personality change all the way back in May of 16 when the stock started outperforming the market. The relative strength indicator went from red to green. Power gauge was already bullish, big money flow. And then look at these wonderful signals. We call this our money flow buy signal that came in along the way, and they've continued. Again, these signals work about 2 out of 3 times. In this case, every one of these signals was a winner. That's unusual. But it's not unusual that a stock with a bullish power gauge rating gives you positive earnings surprises. 4 in a row. The next earnings report is May 4th. We're telling you with our earnings alert indicator that there's another positive earnings surprise expected. So bullish personality change, and then look for the signals. As long as money flow is strong and the stock keeps making higher highs and higher lows, it's a stock you want to be trading options on from the long side. On the other hand, a bearish personality change, as we saw in Coca-Cola back in April, May, June of 2016, tells you that a stock is to be avoided if it's in your long portfolio, your 401k plan, because it paid a big dividend, or if you've been trading it from the long side, time to give up on that idea and get out of the stock and think about it as a put candidate. Now notice, so we've got a bearish power gauge rating, underperforming the market with that bearish personality change, and then right in the middle of the chart, the institutions were really unloading the stock between 44 and 40. Now, this is not a volatile stock, so this is a lot of price movement. But notice in the middle there where I have this yellow zigzag, that's January of 2017. And the reason I highlighted is that on January 9th, CNBC reported that Goldman Sachs had downgraded Coca-Cola and Procter & Gamble to sell signals. Now, that's nice because Goldman's one of the top research firms on Wall Street. But if you were using Chaikin, you would have been bearish on this stock back in May. 44, when you could have been deploying your money in stocks like AMAT and Essent and all the other bullish stocks we're going to look at. And by the way, an activist investor came into Procter & Gamble subsequent to this, and the stock went up into the mid-90s. So as good as Goldman Sachs research department is, you still need an independent check, and that's what the Chaikin power gauge rating does for you. Now, this is the ultimate poster child for why recognizing personality changes is so important. SunEdison was the darling of the semiconductor group. Hedge funds owned it. Merrill Lynch was recommending it up here at 28 to 30. But the power gauge turned bearish in mid-July because this was a highly leveraged company, very similar to a famous or infamous stock called Enron, lots of debt off the balance sheet. And ultimately, it collapsed under the weight of that debt. But you had a bearish personality change when the stock was 25 down from about 30, with the power gauge week, so you had your dynamic duo. And look at the institutions. Buyers or sellers? Type in a B or an S, depending on what you think the institutions were doing from July of 2015 through April of 2016. And I see that we've had an impact because everybody's typed in a big S. Chaikin Money Flow does a great job of measuring institutional buying and selling. And along the way, there were opportunities to buy puts, get out of the stock if you were locked in, because ultimately this chart ends in April of 2016 when SunEdison filed for bankruptcy. Now, Merrill Lynch did put out a sell recommendation on it at $3 in February, down from 30. You've got to be independent of Wall Street research and gurus and be able to see this fundamental information by yourself. We know that there's not enough time to do all the research on 1,000 or 2,000 optionable stocks, so the power gauge rating does it for you. And we got this wonderful testimonial after exhibiting at an options conference last May in California. A broker from Merrill Lynch walked by when I was demoing our system using SunEdison as an example. And he said, hold on, let me take a closer look. He said, oh my God, if I had only had Chaikin, I could have saved my clients a lot of pain and money because I bought SunEdison on the way down at 15 because Merrill Lynch was still recommending the stock. If I had been using Chaikin, I would have known to avoid that. 6 pairs of buy and sell signals. We looked at a couple of them. Go to our website, chaikinanalytics.com, to see them explained. And I'm going to illustrate the importance of the sell signals using a 5-year chart. Now, how many of you have ever been on a webinar, particularly options-oriented, and been shown a 5-year chart? Well, part of the reason is it's hard to get to. We make it really easy. You have the choice between the intraday chart, 1 year, and 5-year. So this is Lam Research, LRCX, a stock that's recently made a new high. And it's had 16 quarters in a row of positive earnings surprises. Shows you how important that factor is in our model. Power gauge has been either bullish or neutral, never been bearish. But for a period of about 18 months, Lam Research was locked in a trading range. Very easy to see that trend line and eyeball it. And then in May of 2016, it broke out of that consolidation. And this is what it looked like when it broke out. May of 16, power gauge turned bullish. The stock had a bullish personality change, so it started outperforming the market. And then look what the institutions were doing. They reversed course. How do we know that? Big mountains of green. And now we're looking for buy signals to get into the stock. And here we have our relative strength buy signal. This is a really powerful signal for options traders. And the reason is, A, it works 70% of the time. Keys off the fact that the stock is outperforming the market. That's part of your plan. And these signals last for 4 to 8 weeks. So you can put on a options trade that doesn't have to be closed out in 3 days, in a week or 2 weeks. You can ride through a couple of cycles and take advantage of these big moves that happen when everything is lined up. Warren Buffett calls this the fat pitch. Now, where that yellow arrow is marks a point in time when I was doing a webinar in February, and Lam Research had triggered an oversold buy signal, new 8-day low with the power gauge bullish. So on that webinar, I used OptionsPlay to suggest that if you wanted to follow that bullish signal, you could put on a bullish vertical call spread, buying the 115 call that expired on March 17th, just a month subsequent to the webinar, and selling the 120 against it, giving you a positive OptionsPlay score and the potential for 156% return if the stock rallied a mere 4 points in a month, 3.5% on a stock with everything bullish. And when that option expired on March 17th, the stock was 123. So people who put on that spread earned the full 156% return, and the stock has continued up to 130. Had a nice pullback today, It's been resisting the pullback in tech. I'd wait a little while before I would put on a position, but there'll be a buying opportunity and a bullish call spread in Lam Research, which reports next Tuesday. That's part of the reason I don't think a spread should be put on here, because this is the advantage of having this one-year chart with the earnings marked. Here's earnings back in April of 16. The stock peaked on a bullish earnings surprise. Then again in July, it peaked on a bullish earnings surprise and went sideways. Yet again in October, bullish earnings surprise, but the stock went down. And in January, same thing. There's a pattern here that I guess the expectations are so high for Lam that when they finally report, people take their profits. Maybe they don't think it can sustain the rally. The bottom line is, after some pause, the stock has gone on to make new highs. So when I did this chart, the stock was down about 2% today. It went a little lower. You get anywhere close to 123 and you're going to get oversold with positive money flow. That's when you want to think about putting on a bullish vertical call spread. Now, something that we didn't talk about in the webinar build-up, I call it the secret trade that 95% of traders never see. It's a bearish money flow sell alert. So on a webinar that we did back in October, Qualcomm had made a new high at the upper volatility band ahead of earnings, and look at the money flow. It was red, not green. The exact opposite of this buy signal here. When money flow doesn't confirm a new high in price or a new low, when stock makes a new high at the upper volatility band and money flow stays red, it's telling us that the institutions are selling the stock under the cover of strength. It's usually individual investors who are buying. That's a great time to sell. We call it a bearish money flow sell alert. And let's see what happened to Qualcomm. This was, again, on a webinar that we did in October when the stock was around 66, although you could have sold it above 70. Here's what happened to the stock. It dropped all the way from 66 to 52. Along the way, power gauge turned neutral. It started underperforming the market. There's your bearish personality change. And it's been a stock to avoid ever since. Now, in a webinar about a month later, we got a very similar signal on Micron, which had been a very strong stock, number of buy signals. But again, after an earnings report, it spiked up and Chaikin money flow stayed negative. A great spot to take some money off the table if you're an options trader. They're giving you a gift because volatility increases, the premium increases, and you can take your profit. Now, I know this worked because my wife, Sandy, who is the poster child for someone who's learned on the fly how to use our simple discipline methodology and beat the market every year for the last 5 years, owned Micron. She bought it down here at 17 on that buy signal. When she saw that spike up after the earnings report, she sold the stock very close to 24 because money flow was negative. But in this case, the power gauge stayed bullish, so did relative strength, and we got a buy signal here in January, an oversold buy. So she bought back into it. I would never have bought back into it. She was confident because she believes in this methodology. Now, we happen to be doing a webinar with Tony Zhang on January 10th, just at the point in time that we got that oversold buy signal at 22 and change. And on that webinar, we suggested this protective put spread. It enabled people to confidently buy the stock or put on a longer term options position and protect themselves. So for $114 with the stock at 22.5, you could have bought this vertical put spread that protected you all the way down to 19.5. And you could confidently ride the stock for the next 5 weeks. And look what happened in that 5-week period. The stock went from 22.5 to 24.5 and then beyond, ultimately peaking at 29. So you can use put options or put spreads to get very cheap insurance to enable you to ride a stock higher. In this case, for $114 per 100 shares of stock, you are in a comfortable position to ride the stock higher. Now, we've been asked in the last 6 weeks whether Chaikin could help in a bear market, because so many commentators on CNBC are bearish. So many people are talking about how the market's overvalued. Smart analysts like John Malden, who's another partner of ours, John Carter. The reality is that we've been in a bull market since March of 09 and rip-roaring 25% since February of 16. So we don't have direct proof of broad market bears, but we do know that Chaikin helped you in the energy sector that Tony was alluding to, which peaked in August of 2014. And here we're looking at the XLE Select Spider Sector Energy ETF. This is the large cap energy components in the S&P 500. And the XLE dropped from 100 all the way down to 50. I think you'd all say that a 50% decline in a major ETF indicates a bear market, and it did. This is our 5-year chart. And notice you had a bearish personality change as the ETF was breaking down. Let's zero in on a stock that did even worse, Kinder Morgan, which was the darling of the yield-oriented energy people, big story about rolling up their companies and so forth. This stock went from 42 down to $10, 75% drop. And Chaikin could have helped you get out of it and find put buying opportunities, because here's where the power gauge turned bearish and you had the bearish personality change. It's so important to recognize those, whether it's SunEdison or Coca-Cola or Kinder Morgan. This happened at $40 a share on the way to 10. And along the way, there were a series of sell signals. Overbought sells when you made a new 8-day high, big institutional selling. There's another message to take away from this chart. It's never too late to sell a stock when everything's lined up against it. These were wonderful put trades. And ultimately, the stock found support at 10. Hedge funds started buying it. Warren Buffett started buying it. But look at all the money you could have made on the short side, and look at all the sleepless nights you could have avoided. One of the investors in Chaikin Analytics is one of the most successful value investors ever. Sold his company to Legg Mason. This was his largest positions. He's a believer in Chaikin, but he couldn't get his hooks out of Kinder Morgan because the yield was so strong, and he felt that they could maintain the dividend, which was 20%. When we took this chart back in January of 2016, the yield was 15%. Ultimately, they cut the dividend. I think you get the message. Now, looking at a stock that Jim Cramer talked about on the floor of the stock exchange, we were going to start the webinar with a clip where he said Marc Chaikin is bearish on this stock, but I don't think we got to do that. You see a stock that's been a big momentum favorite, sort of like Micron, but without the bullish power gauge rating. Has been a dynamite stock on the upside. Chips for cars, chips for games was their original business, chips for everything. A lot of institutional buying all through 2016, but now in February of 2017, we see the power gauge turn bearish. And we got a sell signal here at around 108. And then analysts started commenting on it. Jim Cramer started commenting on it. We tweeted on it, which is how Jim picked up our signal. And the stock was down to 97 here. Is this the start of that Wyckoff bearish pattern? I didn't really refer to this, but this was done 90 some odd years ago. Richard Wyckoff, great market technician of his day, strategist, developed an idealized way that stocks go up and down, and this is the way he conceived stocks going down. It's the same today. You see it in Kinder Morgan. You see it potentially in NVIDIA. Is this going to turn into a disaster? I don't know, but right now people are selling the rallies. And we're going to end the webinar with a nice put spread idea on NVIDIA. So now I'd like to look at a more conservative way, as Tony says, of taking advantage of options, which is writing covered calls, either buying the stock and writing the option or writing an option on an existing stock. So I'd like to just start out by talking about what a covered call entails. Covered call entails selling a call option typically at or above the market on a stock you own or have just bought. And the upside is additional income from the premium you receive. The downside is you've limited your profit potential. So you want to do this at the right time on a stock that you're willing to sell. Because if the stock goes up beyond the strike price, it'll get called away from you unless you close out the option. So we have two examples here. Tony, I don't think you need to share your screen. You can just talk to what we're doing. On a webinar that we did on January 10th with Tony, we had identified Textron as a Trump build up the military play. It had a momentum breakout at about 48. And with the stock trading just under 50, here's what we recommended on that webinar. Again, suggested rather than recommended because this is educational, not specific recommendations. So Tony, why don't you speak to what's on the screen now, the January trade, and then what you could do back here in April.
Yeah, so in January, at the time when it was trading around that 48, 49, or 50 level, we were looking at selling the March 17th 50 cover calls, which gave an annualized return of 25%, which is a very high return at the time. And I believe that call ended up expiring worthless at March 17th.
It did.
And then today, now that we're looking at Textron, we're looking at selling the May 19th 49 cover call. So very similar cover call. The annualized return on this one is 22%. So very similar risk profile and very similar returns here. And we think that we can do this again month after month. And this is how we get consistent income month after month using a strategy like this to bring in some additional income.
So to summarize here, if you bought Textron at 47, 48 based on the Chaikin methodology, you see it up at 50, you think it has more potential, but you're looking for income from a stock that has virtually no dividend. And back in January, you could have gotten $228 per 100 shares. That's a nice 4% return. See it expire worthless or sell it at 50 plus 228, so 52.28, so a nice 10% gain on your position. But in this case, they expired worthless, and now you're taking in another $112 per 100 shares, giving someone the right to buy your stock at 49. It's trading at 47.43. If this expires worthless, you've taken in almost $3.50, the equivalent of about an 8% yield on the stock. You still own it with the potential, as Tony says, to rinse and repeat, do it again in May, writing a June or a July call. Now let's move on to a new idea. I screened using the screener that you've already seen, but in this case, I added the requirement that the company pay at least a 2% dividend. So strong earnings surprise, earnings consistency, so I know the dividend is secure, very bullish stock, and we reduced our candidates down to 9 names. One of them is Principal Financial Group, insurance, annuities, mutual fund management. Here's what the stock looks like. Gave a buy signal back here at 60. So let's say you had bought the stock at 60 on that buy signal. Here's what you could be doing today using the OptionsPlay module. And Tony, you might want to just run through this.
Yeah, so once you click on the income tab, you'll be presented with cover call ideas. So in this particular case, what we did was we scanned for the May 19th 65 cover calls. That brings in $200 or $100 per contract, which again yields about 15% annualized return. And once you include that dividend, your 12-month projected yield here is about 18%. So that's really boosting your yield, because if you're just holding the stock, you're earning close to about 3% on the dividend. By adding cover calls to it, you're boosting that up to about 18%. So it's a very great, very interesting way to add additional yield to your portfolio if you're looking for additional income.
And another way to look at it is, here's a stock that yields just under 3%. In 1 month, you're earning 1.59%.
Exactly.
Roughly half the annual dividend and you're willing to sell the stock at 65, which you bought at 61. So it's a win-win situation. Odds are this call is going to expire worthless, and then you can do it again. So covered call writing, we get a lot of demand. People want to know about it. Going to end the webinar talking about earnings season, very volatile price action in stocks because there's so much speculation about whether companies are going to meet or beat or disappoint. And the power gauge rating really is your friend. As I said earlier, it's your GPS during earnings season. So here's an example of how you could have made money on the short side with put options using TripAdvisor, where everything is lined up to the downside. Power gauge bearish at the bottom, underperforming the market. There's your dynamic duo, institutional selling, and then sell signal right before the last two earnings reports. Stock dropped over 28% in each of those periods following the earnings. Imagine how profitable put options were. And again, these were your relative strength sell signals that tend to last 4 to 8 weeks and work about 70% of the time. Now, here's that Schlumberger example that Tony gave us. You can see the chart with the sell signal. We've already been through that one. That's the spread. When I did this morning, it was suggesting the 79.5, 74 vertical put spread expiring on May 26th. Again, that encompasses that earnings date of April 21st. It gives you plenty of time, if they disappoint, to make money on the put side, on the short downside with that put spread. And here's how we help you monitor, because how do you know what stocks are due to report? Well, if you look at the chart, you'll see it. But in my weekly market insights, we highlight the stocks that are due to report in the coming week. In the upper left-hand corner, these are the stocks that were due to report last week. Acuity Brands with a bearish power gauge rating, and CarMax, which I made my bearish stock of the week in my market letter, which dropped 6% last week, were two that caught my eye. And then this week, we've got the financials reporting on Thursday. Progressive, that insurance company with acute commercials, and then the big banks, JP Morgan, Wells Fargo, Citicorp reporting. But let's see what happened to Acuity Brands, which reported on Tuesday last week a bearish earnings surprise that had been preceded, just as in TripAdvisor, by a relative strength sell signal, and the stock dropped from 205 all the way down to 170. And that shouldn't have been a surprise, because look at the last 3 quarters, negative earnings surprises. Big gaps down in 2 out of those 3 quarters. So when everything's lined up, you can buy an inexpensive put option. It's what I call a binary trade. You're either going to be wrong and lose what you pay for the put, but you've limited your risk, or you're going to hit a home run and make anywhere from 200 to 500% when they work like this one did. And some of our subscribers have achieved that kind of return, 10x return in 5 days. In the 5 business days I've been using Chaikin, I've paid for the subscription over tenfold. These initial results are nothing short of outstanding, thanks to the team. Again, it's a team effort. We started with 2 people, my wife and I, in 2009. We're 28 people here in Philadelphia, dedicated to your success. Plus, we've got partners like Tony Zhang and OptionsPlay who add real expertise to the mix. Now, the final piece of functionality I want to show you is probably what I'm most excited about in this 7-year journey. We call it our stock discovery engine. It works just the way Spotify finds you music, or Netflix finds you films that you like, or Amazon suggests books or gadgets that reflect what your interest is. You seed the stock discovery engine with a symbol that you're following. In this case, about 3 weeks ago for a webinar, I seeded it with Under Armour, which we've already saw as our classic Chaikin bear, because I wanted to see other apparel stocks with bearish ratings and also potential swaps out of Under Armour into a stock like Skechers, which had a bullish rating. But what caught my eye was Lululemon, because we've been bearish in terms of the power gauge on that stock for almost 3 years. And it had a very bearish rating, just as Under Armour did. Mid-cap apparel stock, bearish earnings estimate trend, featured bear. And this was for a Thursday webinar that we did 2.5 weeks ago. And look what happened to Under Armour the next morning. Bearish earnings surprise. Stock, which had rallied into the earnings report, as often happens, it's sort of short covering plus wishful thinking, dropped over 23% the next day. So if you had prepared for that, either followed the signal or bought the put option as close to that earnings report after the close as possible, big, big profits to be made. Now, we talked about NVIDIA and how we saw the bearish power gauge on a webinar that I did on 3:30. I entered Micron, which we've already looked at as a bullish stock, into the discovery engine to see other stocks like Micron. So I got 5 other semiconductor stocks as potential buy candidates, but it also showed me a potential short candidate, technology stocks that had a bearish rating. And there was NVIDIA at 108.84 with a bearish rating. That's what the chart looked like. We had just had a sell signal, the power gauge turned bearish, and NVIDIA is breaking down. So if you wanted to press the bet and put on a bearish position in NVIDIA, and I don't tend to like to do this on weakness, I'd rather do it on strength, but we want to use this as an example. Here's a bearish put spread from OptionsPlay, buying the May 97.5 put that expires at the end of May and selling the 85 put against it. For $430, you can control $10,000 worth of NVIDIA on the downside for the next 6 weeks. If NVIDIA drops from 97 to 85, there's a 200% return, but you've limited your risk to just $430. Now, NVIDIA reports earnings on Tuesday, May 9th. So if there's a negative earnings report, and the power gauge is suggesting that, as are some Wall Street analysts, this stock could easily gap down. 85 is not a big stretch. It was trading at 85 back here in November. So if you got that move from 97.5 to 85, almost a 200% return. If you do it on a bounce in the stock, you'll be able to put that spread on at a better price, maybe 380, 375. Now your return jumps up to 225% if you're right. So that's the way you can use the combination of fundamentals, technicals, and options play to skew the odds in your favor and become one of those 5% of investors who do make money trading options. So I promised you a special offer. Chaikin Analytics now comes with our discovery engine, OptionsPlay, the screener, earnings alerts, news, and intraday charts. It's the complete package. Everything but your brokerage account bundled into one screen. So what are your next steps to success in 2017? Call us and reserve your free subscriber onboarding training session and start getting our daily and weekly market insights. Sign up for personal coaching sessions and begin applying the Chaikin methodology to trade options profitably tomorrow. So Chaikin Analytics is normally $1,950 a year for an annual subscription. As a webinar special, we're reducing the price by $200 down to $1,750. You can go to chaikinanalytics.com/options. This offer is good until Friday, April 14th, Good Friday. It'll be good for you because it'll improve your options trading. Now, we got one testimonial that I'm really proud of. We call it the $1 million testimonial. It just came in on March 27th. Tremendous service and excellent methodologies. He also said the best product and support he's ever seen. Through following your excellent system, my portfolio now stands in excess of $1 million. Before Chaikin Analytics, I'd make money, then I'd lose it. But there were no consistent earnings for me, and Chaikin has changed all that. And I can't thank you enough for this service and the methodologies. You can do this for yourself by subscribing to Chaikin Analytics. We add value with small group tutorials. Joe Bacella and his customer success group, Michelle and Josh, will get you onboarded. We do them every day at 2 o'clock. My colleague John Schlitz writes Morning Insights, which Means you don't have to stay glued to CNBC while you're drinking your morning coffee, because John recaps what happened yesterday, what's likely to happen today, what's going on overnight. And then my weekly market insights gives you my view of where the market's heading and why, and which stocks and groups are strong and likely to stay that way, and a specific stock of the week, bullish or bearish. So here's that final inducement, that special offer that we promised you. If you subscribe by midnight tonight, we'll take an additional $100 off the cost of Chaikin Analytics, reducing the annual subscription to $16.50. We protect you on that because when we introduce our power gauge ratings for ETFs, hopefully by the end of the second quarter, we're going to actually have our first price increase in 4.5 years. So if you subscribe by midnight tonight, $1,650, and for the first 7 people who subscribe, you'll get a one-on-one half-hour to 45-minute telephone call with me after you've gotten your onboarding session. Talk about everything except specific stock or options recommendations, but strategies, what's been going right for you, more particularly, how can we help turn around what's been going wrong. These are really valuable sessions. I love doing them, and the feedback we get is wonderful. So subscribe by midnight tonight. Be one of the first 7 people to call. $16.50 and the one-on-one session with me. I want to thank Tony Zhang. He's been a great partner, and what he's created at OptionsPlay can't be valued highly enough. It's just what you need to make options trading easy, takes the pain out of options trading. And with that, I'd like to turn it back to Joe Bacella, who will wrap up the webinar.
All right, thank you so much, Mark, and thank you everybody for sticking around for our presentation this afternoon. I just chatted out to everybody a direct link to Mark's offer, chaikinanalytics.com/options. You'll be brought to a fulfillment page such as you see here. And again, the discount code will automatically be applied. Again, this is available until Friday, but really the $300 discount is available only until midnight tonight. We have a lot more support webinars to host this week. Tomorrow, of course, will be on our onboard session, which is perfect for each one of you. A great walkthrough through the Chaikin Analytics program, as well as a thorough walkthrough through OptionsPlay. And then, of course, on Thursday, we'll be hosting our pre-market analysis webinar and our options analysis webinar. All of these only for our own subscribers. And so, again, just really making this discounted offer all the more worth it. So with that said, I want to thank Mark, thank Tony as well for joining us for our presentation. In the meantime, everybody have a wonderful evening, and we'll see you tomorrow on the onboard session.